Hi, I'm Cody from Wall Street Breakdown. We've been going through a lot of fundamental analysis metrics here on this channel in 2018 as people really try to deduce what they want to be invested in, especially in a market like right now where the market is up and price to earnings are, let's just say, well out of range of historical norms in almost all sectors. People have to use more and more tangible, and I don't mean that, no pun intended for what the topic is, but tangible metrics that are available that they can mix together and try to find the best assets to get invested in, because you can't just sit in cash. So today, we're talking about the price to book and price to tangible book metrics that are basically what we're looking at when we're talking price to book or price to tangible book. And I'll explain the two differences in a second. What we're looking at is the share price, the cost of the share price in relation to the actual book value of that underlying company. So we're basing that book value based off their quarterly report, their last quarterly report. And the book value is very easy to get. They take their assets, they take their liabilities, and they subtract liabilities from assets, and lo and behold, there we are, finding out what the actual book value of this company is. And then the share price or price to book would be what the market deems the reasonable price. So you can get a price to book that obviously, and you're going to get these in every sector, it's going to be very, very different, where things are way overvalued. You're looking at a price and you're saying, okay, I understand. In relation to the value of this company, the actual value you see on paper when an accountant looks at it, you're not going to see that reflected in the actual share price. Sometimes you can get companies like Boeing right now that happens to be the highest price to book company on the entire S&P 500, well over 400 for a price to book. So their share price in relation to their book price, 400 to 1, or over that. But when you look at it, it's because 4,000 planes plus in the backlog, a company that basically has no competition whatsoever. So when you look at a company like Boeing, you realize that the market takes their share price and takes the book value into some consideration, but it definitely doesn't reflect how the market looks at things. Whereas other companies, you're going to see a price to book value be a lot closer to 1 or 2, where they're not going to get too far out in front of themselves. So companies that hold a lot of assets, because that's obviously what we're going to derive our book value from, are going to be the companies that are going to have the much more relatable price to book ratio, I guess you could say. If you take a look at a company like Ford or US Steel, they hold a lot of material, they hold a lot of product. There's a lot of things that could be sold if this company ever went bankrupt. Ultimately, the price to book is giving you a good relation when you're looking at if a company ever defaulted. You know, like that's what you'd end up getting. And when you're talking about something like Boeing, obviously you're not looking at a company where there would be a whole lot kicked back to the common stockholders at the price that they're at right now, if they happen to default tomorrow, which obviously isn't going to happen. But with a company like US Steel, they're holding a lot of assets. They hold a lot of land. They hold a lot of material. They hold a lot of, there's a lot of assets. There's not a lot of patents. There's not a lot of intellectual property. None of that stuff is really a thing involved in their company. Whereas other companies like an Amazon or a Netflix or a Boeing, you're talking about future share price, well priced into the price currently, right? We're talking earnings for the future being regarded in the share price, reflected in the share price right now today. So companies vary in a wide variety throughout the sectors and throughout what that company is doing, as far as if it's a growth company or if it's a company that holds a lot of assets. So this price to book is something you need to use definitely in a mixed bag of fundamental analysis, and not something you want to use exclusively, because you can get very, very skewed numbers that, if you're just looking at that number, isn't really going to give you a lot of information. Because obviously Boeing, What are we up, 30% in 2018 so far? Boeing's doing pretty good. But you look at a price to book or price to tangible book, and the numbers don't make you feel safe. But you have to take the full picture of the company in relation to their sector, and the company in relation to the economy, and the company in relation to obviously 4,000 planes in a backlog. And all of a sudden now things look a lot better. So price to book, good, used in unison with other stuff. Tangible price to book is not going to be the same as your book value. Hence the reason both numbers are different. You're going to find tangible book usually higher than the book value more times than not. And more times than not, as you get more and more into technology, you're going to find that tangible book value significantly higher than what you're going to find the actual book value of a company. Because a company is not going to have near the amount of hard assets. So when we're looking at a tangible book value, that's, we're discounting intangible book value. Patents, so this is tangible book value, is going to be discounting. This is not going to be allowed to be included as assets. Patents, intellectual property, and goodwill. Goodwill being what your brand is worth. So like the premium a company might otherwise pay to pick up a company like Disney, right? There's a lot of goodwill there, but they're not allowed to price that in. So when we're talking about book value, we're talking about assets that are allowing patents, intellectual property, goodwill to be priced into the accounting. When we're talking about the actual tangible book, that tangible book value is going to completely discount that. And we're talking now hard assets. So if we needed to liquidate today, what could we liquidate? That's going to be reflected in your tangible book value, whereas your book value is going to be a little more liberal on the assumption that a company is going to get value for their brand name, for their patents, for their intellectual property. But again, that might not happen. You have a company, and it's very rare, but a company like Enron that dissolved very, very quickly, and you went from a brand name that was very valuable to so scandalous that the actual name wouldn't have been worth anything. So to price in things like Goodwill, you could be pricing them in, and in the midst of a scandal, that Goodwill could dry up quite quickly. So your tangible book value, obviously going to be more of a concern if we're talking about people having to liquidate anything. This is what we're concerned about if we're a common stockholder. I don't know if you know what the chain of debt dispersal is going to be, but it's going to definitely be, banks, your primary lenders. It's going to be bondholders. It's going to be Class A shareholders. There's a lot of people above the common stockholder. So the higher we get at a range with a book value, if you're worried about a company defaulting, again, we talk about Boeing, very high book value, negative tangible book value. We're not worried about them defaulting. There's no reason to concern ourselves with that. So, it's not a thing. But if you're worried about a company potentially having some issue, you want to make sure that you're finding a book value or a tangible book value that is a lot more close to 1. If you see one's under 1, you're looking at a company probably already in dire straits financially in some way or another. They've missed on earnings a few times, hardcore. There's been some sort of issue. And you're going to see that, but you're not going to see that overly often. If you see a company below 0 or below 1 on a tangible book value, 0.96, that doesn't even make sense, because you could in theory sell that company for more than what it's trading for at that point in time. So you take that share price and say, I could actually, this company could be sold and broken up, and everybody could still get paid, and there would still be money left. So if you see a tangible book value under 1, that's definitely something to ask some questions about if you see that out there in the wild. So land held, when we're talking about the book value, we need to understand that land in the asset class is going to be there, but it's going to be held in historical values. It's not going to be held with appreciation attached to it. So you could get some skewed numbers if you have companies that hold large amounts of land, especially if they've owned them for generations and generations. They have plants, manufacturing, whatever it happens to be, office buildings on this land. This land hasn't had a chance to appreciate in value in the book because they haven't gone to sell it. So even though obviously the land's been appraised, and we all know that land, when we're talking about assets minus liabilities, that land is being held at historical prices, not being held at the current price. So some companies, again, that hold a lot of land might find that, especially if they've held it for a long time, might find the book value to be a little bit skewed. And that's because the appreciation hasn't been tagged on to the land. So we've got to remember that the stock price of all of this, the stock price is reflecting a future value for that company. And the book value is basically giving us a look at what that company's assets are worth. So it's not something that's going to be your predominant predictor of if you're making a good investment, but it's definitely a good idea to take a look at it just to see how that company is doing in regards to companies that it's very similar like. Right? Like, so you're going to have companies in sectors that are going to have price to book and price to tangible book of values that are going to be quite comparable. Let's just put it that way. So when you see the comparison, it gives you a chance to see if a company's share price is pricing it out of the marketplace in regards to its competition. And then you ask the question, well, is this relevant? Is that growth there to significantly justify why that company is being priced out? Or does this start to make these other companies inside this sector a lot more valued, and that company start to look like it's a little bit overbought? So there is good reasons to use price to book and price to tangible book. And again, remember what the differences are. Price to tangible book, not including patents, intellectual properties, and goodwill. Price to book, basically allowing you to put all that stuff in there. It's a good way to look at what a company would be broken down for if it had to be sold, went into default, and what a common shareholder, a lot of the time might get back from that company. But other than that, again, can be very skewed by a share price that's high because the company's growing and they just don't hold a lot of actual physical assets. That's price to book and price to tangible book. I'm Cody from Wall Street Breakdown. I hope these fundamental videos are really helping you guys out. If you've got anything you'd like to see specifically, please drop us a line and let us know. We love hearing from you. Otherwise, have yourself an outstanding rest of your day.